Hello everyone, my name is Roman Kosarenko. I oversee pension investments at a large Canadian corporation. In spare time, I write articles on LinkedIn. But today I wanted to do something different. Today, I offer you a video interview with a person who is very knowledgeable about multi-employer plans. Let me introduce James Pierlot, the founder and the Chief Executive Officer of Pier. Pier is a multi-employer plan of a unique design. James is a member of a multi-employer plan advisory committee at the Financial Services Regulatory Authority of Ontario. The topic of today's conversation is not Pier as such, but multi-employer plans in general, their evolution, their place in the industry, and what could the version of the retirement plan of the future be. First things first, I have no personal connection to James or his plan in any way, and neither of us is getting paid for this interview in any way. The views expressed here are mine, by me, are mine and mine only, and don't necessarily reflect the views of my employer. So welcome, James, and thank you for agreeing to take part in this experiment. Since our topic today is multi-employer plans, I looked up some official data. According to StatsCan, the number of active members of multi-employer plans was just over 1 million in 2019, which is almost the same as it was in 1992. We know that pre-2007 data were not measured in the same way, but we don't have any alternative facts to consider either. So what is your view? Are multi-employer plans a growing part of the inter-retirement industry, or it is indeed a stagnant component for some structural reasons?
So thanks, Roman, for the introduction and for setting up this interview. It's always fun to talk about multi-employer pension plans and pension coverage in general, which obviously is an interest of mine. Pension plan coverage has been in a secular decline for more than 30 years, and the statistics show essentially what you say. It's membership in pension plans and multi-employer pension plans, particularly in the private sector, has been stagnant. So what are the reasons for that? Well, multi-employer pension plans are essentially, they have thrived where there is some large organization, such as a union or a government, which has the resources to establish them and a direct business interest in offering that to a constituency, for example, the union members, the employees, etc. In the public sector, you've actually seen growth in the membership of public sector pension plans in step with the growth of employment in the public sector. But in the private sector, union membership has been stagnant or declining, and pension plan membership has also been stagnant or declining fully in step with union membership. So there is no, there's really no entity outside unions or government historically which has had the interest in engaging in the exercise of establishing a multi-employer pension plan that's independent of the employers, independent of the members, and which can sort of welcome any employer. There's a lot of sunk costs in doing that. The only example that I'm aware of where that's actually happened, or the attempt has actually happened other than Pier, was the Ontario Retirement Pension Plan back in 2016, which never actually got established.
Thank you, James. Very good observations. Multi-employer plans have evolved to be industry specific, more or less. And that, in my mind, brings demographic challenges into picture. We know, for example, that Ontario Teachers' Pension Plan has to fight the demographic wave of retiring plan members. Longevity can be industry specific as well. For example, there are known differences between blue-collar and white-collar positions. It seems that the stability of the multi-employer plan depends on the diversity of its membership. That, however, increases complexity and may lead to hidden risks to participating employers. What is your view of that issue? How broad or diverse a pension plan of the future should be?
I see the challenge with multi-employer pension plans as not so much one of diversity or having diversity within the plan as having a proper balance between demographic balance between the plan, between younger and older members. as you know, the baby boom generation is a very large cohort, and it moves through the system. And as it ages, there aren't nearly as many active members of pension plans as there are retired members. So the ratio, I think, in Ontario teachers is maybe 2 or 3 active members to for every retiree, and it used to be, you know, maybe 15. And so as a plan as a plan ages, or as the liabilities age, you know, you can take less investment risk. The difficulty with diversity of pension plan membership, where you're pooling longevity risk, is that if you have demographically diverse membership within the same plan, in other words, different levels of education, collar type versus blue and white, et cetera, you will have different life expectancies at retirement among those groups. And if they're all paying the same level of contributions, then that necessarily means that some are going to be subsidizing others because, for example, the coal miner may live 7 years less than the investment banker. If you put the two in the, to take an extreme example, you put them in the same plan, one's going to be subsidizing the other if you're pooling longevity risk. And so, you know, I think the issue with multi-employer pension plans is about figuring out how to put diverse groups into a plan where one and get the benefits of economy of scale and pooling, but without having these sort of subsidies happening under the hood that people don't know about and perhaps wouldn't like if they knew about them.
Oh, some level of subsidization is inevitable. CPP subsidizes investment bankers the same way as coal miners.
It does. Well, it subsidizes the investment bankers more than it does the coal miners, obviously, because the investment bankers live longer. And some kinds of subsidies are inevitable because there will always be variances in at retirement life expectancy, even within demographically similar groups. And that's fine because that's kind of random. But where you have demographic differences, material ones within the same pool, just because a CPP does it doesn't mean that every other plan should do it.
Mm-hmm. I want to contrast some of the aspects of the multi-employer model with the single employer plans, which is a subject I know very well. From my perspective, the line of responsibility is always very clear with single employer plans. It is always clear who is the first defendant in a potential lawsuit. Multi-employer plans are very diverse and their governance can be quite complicated, even to regulators. Some multi-employer plans own their service providers. There is this interlocking relationship among unions, their plans, and their service providers, which is difficult to tackle. How important is good governance for a pension plan in general? Is it a significant challenge for existing multi-employer plans? Are we due for statutory intervention, perhaps, on that front?
So, well, that engages a lot because pension governance is a complex topic. But I would challenge the notion that the lines of responsibility in a single employer pension plan are always quite so clear. There's never a single person who's responsible for everything. The administrator of the plan is a board of directors, usually in a large company, and or people on the Human Resources and Compensation Committee. Those people are a revolving door. Directors come, directors go, committee members come, committee members go. And that entity, the board of directors, is really serving two masters if it's operating a pension plan, and with conflicting responsibilities. On the one hand, they have to maximize shareholder value. So that's one constituency. They're agents of the shareholders. And on the other hand, they're supposed to be a fiduciary taking care of the interests of the pension plan members, which may conflict with the interests of the shareholders. So they're in a structural conflict of interest. And in a 1995 case involving Imperial Oil, the Supreme Court of Canada articulated that as a two hats situation. So when they're serving the pension plan members' interests, they have to put on their fiduciary hat, and when they're serving the shareholders, they have to put on their fiduciary hat in service of the shareholders. And for the most part, employers do kind of manage that conflict fairly well, but there are some spectacular examples of failure. And when things go wrong with that model, they go very wrong. In the multi-employer pension plan, of course, you have the separation of the sponsor and the administrator roles. The sponsor is the person who establishes the plan in the interests of, to serve some business interest, attract and retain employees, et cetera. And the administrator is the fiduciary, responsible for statutory compliance, benefit delivery, proper administration, investment management. And those roles are separated. In a multi-employer pension plan, the administrator is a board of trustees, the sponsor is the employer, everybody knows what their job is. That's, of course, in an ideal world. Now, in some multi-employer pension plans, trustees may have other allegiances because they were appointed, say, by a union, or they kind of have an implicit representation of an employer group. And so that presents an issue, and it has been an issue in certain multi-employer pension plans, as I'm sure you're aware. And then there are other types of pension plans that you see. For example, a good example would be the jointly sponsored pension plans in the public sector. They have a more independent expert board of trustees, and the sponsor function is explicitly separated from that. And the board of trustees function is really to ensure sustainability of the plan over time. And so I think the two key drivers of good pension governance are, or good pension outcomes and pension management, are good governance and scale. And good governance, in my view, involves having an expert board of trustees with specific and relevant subject matter expertise. It could be in actuarial science, in investment, in governance, in law, in accounting. I mean, the board of trustees cannot be experts in everything, but they have to have some knowledge of something that is relevant to the operation of a pension plan. And they have to be independent of both the members and the employers, and have their fundamental accountability needs to be toward the constituency that matters, which is the plan members.
Mm-hmm. Thank you. Thank you for that. In industry press, multi-employer plan model is often presented as the best of the both worlds. To a plan member, it can be a defined benefit plan, and to an employer, it looks like a defined contribution plan. It is also a trusted plan where the people who oversee the plan must act in the best interest of the members. Yet somehow multi-employer plans are hardly a breakaway success. An RSP plan is arguably an inferior product since it's legally an individual contract with a for-profit financial institution, and there is no one acting in the best interest of the subscriber. RSPs have tax disadvantages to employers and management expense disadvantages to subscribers, and yet RSP asset growth outpaces the asset growth of trusted plans, including public plans. Why do you think that the model, which is fundamentally more sound, is not more successful?
So I'm going to take issue with the idea that pension plans can, whether it be a multi-employer pension plan or any other plan, can provide certainty of contributions and certainty of benefits. Something must be volatile in the basic pension equation of contributions plus investment returns equals benefit payments plus expenses. And over time, pension risks are really on a continuum. You can never really say that there's no risk to an employer or no risk to members, because you're talking about entities with very long-term time horizons. So really, those risks exist on a spectrum. So legally, for example, in a specified Ontario multi-employer pension plan, or SOMAP, you might have the employer contributions are limited to a fixed amount set in a collective agreement or on a per hour basis, et cetera. But if there's a funding difficulty in that plan, then there's kind of an implicit call on one or more of the participating employers, because in the collective bargaining process, the union might say, well, we got a problem with the pension plan and we need you to help out with that. even though the employer has no legal obligation to do so, it might be a very bad business decision not to negotiate on that point. So there's never certainty of contribution and certainty of benefit. No one can make promises. A pension promise is going to be paid or not paid to the extent that there's some kind of asset backing it. And that asset could be a call on the assets of an employer, or it could be an actual financial asset sitting in a pension fund. And it's going to be paid. There's also the fact that you don't know really until a person passes away what the liability actually was for any given individual. So there's a lot of uncertainty. I'm kind of curious where you get the RSP and MET numbers. I mean, the Stats Canada data that I look at show that, you know, you're looking at in the trustee plan sector, which is largely multi-employer pension plans in the public sector, or like multi-employer like plans, you've got assets of close to around $2 trillion right now. And those have been growing, you know, I think from 2014 to 2018 grew about 17% versus what StatsCan reports for the RSP data, about 8%. So growing at double the rate. So that seems to suggest that the MET model is kind of successful in the public sector, at least, and is gathering more assets.
In the last few years, definitely. But if you look back to 92, probably not as much.
No, definitely not as much. But if you look back to 92, you also see a much higher rate of pension coverage in the private sector, which potentially absorbed some of the RSP savings that would otherwise have gone, or the savings that would otherwise have gone to RSPs.
That's right. Yes. So there are definitely certain issues with the stats that we have. I wanted to follow up on that issue that you took in the last response. And one of the perceived advantages of the multi-employer plans is that somehow those onerous solvency requirements don't apply to them, either explicitly as in specified Ontario maps, or implicitly they should be balanced through some combination of negotiated contribution increases or possibly benefit reductions. Yet the benefit reductions rarely, if ever, happen in practice, and sufficient increase in contributions is difficult to negotiate when multiple employers bargain using different schedules. So what is your take on the contingent funding liabilities that are implied for those negotiated contribution DB plans? Are they real? Can you have your cake and eat it too?
Well, it's not a popular view these days, as we're seeing a transition really across the country and among pension regulators from, you know, a solvency funding regime to a going concern or a going concern plus funding regime with provisions for adverse deviation, which are sort of lead to a funding security level that's on some midpoint between solvency and going concern. You know, if you go back far enough, everything that's old is new again. And it used to be the case that plans were only funded on a going concern basis. And then there were big plan failures. And then the regulators came along and policymakers came along and said, well, this doesn't make sense. We need to have proper funding of pension plans. And they implemented solvency rules. So, and solvency is, of course, you're supposed to have enough money in the plan so that at any given point, if the sponsor goes bankrupt, there'll be enough money in the plan to settle out the benefits by way of commuted value transfers, annuity purchases, et cetera. And so that definitely improved benefit security and outcomes for members, but then interest rates declined and investment returns in the portfolios declined, and that the declining interest rates and the increasing life expectancy drove up the liabilities. And so people said, well, solvency is too expensive. And so now we want to go back to going concern and going concern plus, because over the long term, everything will be fine if we get the rate of return that is suggested by the discount rate we've chosen and our historical rates of return. Everything does work out in the long term on that scenario, but the problem is that the entities sponsoring pension plans, the average lifespan of a company in Canada or a business in Canada is under 10 years, whereas pension plans are very long time horizon entities. So what if a sponsoring employer disappears and there's a solvency deficit? Is some other employer going to be asked to step in and fill in that gap? Solvency makes sense as a funding paradigm because it really gets you to closer to full settlement of the obligation on a risk-free basis. And some people will say, well, that'll throw up surplus, and then there'll be arguments about surplus at some points, and that is true, for sure there will. But I would argue that that's not a good reason. Just because you have to deal with the upside, and sharing the upside is not a good reason not to have upside. And to structure a funding regime which over time creates a probability that pension benefits will be underfunded and people will not get what they were promised.
Mm-hmm. You are a rare supporter of solvency rules, James.
Which it is not a popular view these days.
Yes, yes. One of the apparent trends in Canada is the conversion of defined benefit plans to a jointly sponsored plan model, where the funding responsibility is shared and no longer subject to collective bargaining. In one characteristic example, the unionized members of the Ontario's Workplace Safety Insurance Board pension plan gave up their right to bargain over pension contributions in order to permanently block either a defined contribution plan or a target benefit plan. So is the JSPP model just so much better, more robust? Are there any weaknesses in that?
So the JSPP model, just so people who are not aware of it, understand how it works, is in a single employer pension plan, which is defined benefit, the employer is ultimately the guarantor of the benefits. And if there's some kind of a deficit, the employer has to pay it off. In a jointly sponsored pension plan, the word sponsor means to take funding risk, to have some kind of upside and downside. So if the plan has a surplus, the employer and the employee contributions, which are typically 50-50, will both go up and both go down commensurately with the funded ratio of the plan. And so what a jointly sponsored pension plan does is it sort of takes half the funding risk, or half in most cases, not in all cases, but in most it takes half the funding risk away from the employer and transfers it to the members as a group. And there are a number of advantages to that model because first of all, the employer has less funding risk, which obviously the participating employers like, but the transfer of funding risk to members also makes them take a greater interest in the operations of the plan and perhaps to be a little bit more realistic in terms of the benefits that they expect to get out of it, because if they want more pension, they are going to have a direct impact on their paycheck. And they want the plan. And so that leads to a tension and perhaps more realistic view of it. Now, one of the features of a JSPP that's like a single employer pension plan is that it's not possible to reduce the nominal amount of a pension benefit paid to a retiree, unlike other types of multi-employer pension plans where that is possible. So that puts the retirees into a sort of a special category or a privileged category, because if there's some kind of problem with the funding of the plan, you can't call on them to share in the pain to keep the structure sustainable in the interests of everyone. Now, some JSPPs have addressed that by either having or introducing something called conditional inflation protection. So if there's a problem with the funding of the plan, then of course you cannot provide an inflationary increase in pensioners, and that actually makes them participants in the funding. But there are problems potentially in the plan if you, if you have those demographic differences within the longevity risk pool. So for a demographically homogeneous group, then the JSPP can make a lot of sense if the employers are willing to accept the funding risks that go on, that happen with the JSPP.
What you are talking about is generational fairness, I think, right? Because the current employees are taking all of the risk, and those who are retired, they don't. So, what's the is it something that needs to be built by design? This generational fairness in a multi-employer plan?
My view is that the sustainability of multi-employer pension plans and pensions in general um, should not should not trade on information asymmetries. And what I mean by that is if people knew that there were persistent subsidies within a pension structure, then they probably wouldn't be supportive of it. And if they don't know about it, and that's the only reason why it's working, I think that that's kind of a problem from a systemic structural point of view. So there's no reason why retirees can have risk and still have adequate pensions and good and happy retirements. So the federal government a couple of years ago introduced the idea of a variable payment life annuity. And that was an annuity within a pension plan where instead of getting fixed and equal periodic payments, which necessitates a matching risk-free asset, which of course has a very low rate of return, instead the members can participate in the upside of the capital markets in retirement as they did during the accumulation phase and have a larger pension, even though the pension amount might fluctuate from year to year. And so risk is not necessarily a bad thing, even for retirees, because it presents the opportunity over time of getting more value. And so I think that a lot of this comes down to a communication exercise. You need to make sure that if you promise someone a pension, you should be delivering it. But maybe the promise needs to be contextualized a bit to say, this is the target pension that we're going for, but we can't guarantee that it will always be that amount. It might be more, it might be less, but it should be within this range. And really it's about probabilities, not certainties, because when you promise people certain things about the future, you're doing something that you cannot do because no one can predict the future.
Mm-hmm. Regardless of the funding model, multi-employer plans in Canada, with the sole exception of Quebec, I believe, are subject to the same community value standards. These standards specify the value of accrued benefit that the terminated member can opt to take out of the plan. The discount rate applied is substantially lower than the going concern discount rate, so that creates asymmetries again. What is your position on commuted value? As an embedded put option, is it unfair to the remaining plan members?
Well, I think it's clear, it may not be a popular view, but I think it's clear that if you value the pension for one purpose for the people who are in the plan and you discount it at a relatively high rate, like 5 or 6%, and then the people who leave the plan get a bigger amount for their promised pension benefit because you're discounting it at a lower rate, you have advantaged that person to the cost of everyone else, because as they take money out, the funded ratio of the plan for the remaining members drops even below what it was for them. So on it from a purely fairness point of view, I'm not sure why we would have a system where we give a commuted value to a person valued at a different discount rate or a different valuation method from the people who remain in the plan.
Mm-hmm. James, you're a lawyer by trade, and you studied law in Montreal, in Toronto, and also in France. There are certain parallels between Canadian and European pension challenges, as both sides need to deal with regulatory fragmentation. It's interesting that the recently announced pan-European pension product is an individual savings vehicle, somewhat similar to Canadian RSP or an IRA in the US. If you were to speculate, could a Canadian multi-employer plan evolve to permit individual membership, kind of along the lines of those regulatory changes in Europe?
Absolutely. I've long advocated for individual membership in a pension plan. It's a curious aspect or artifact of the Canadian tax rules for retirement saving that go back more than 100 years now, that you cannot be in a pension plan unless you have an employer who is willing to contribute to it on your behalf. And you can't even use your own money to fund a pension in many situations because of 50-50 funding rules, et cetera. So we're in a situation where employers don't want to set up pension plans because of the costs and risks of operating them. And you got to remember that in the private sector, 70% of all workers are working for companies that have fewer than 100 employees. They just can't set up pension plans. It's too complex for them. So you end up with close to 70% of the workforce, more than 12 million people in Canada without pensions. And so if you have individual members of a pension plan, in other words, I could join a pension plan established and it could have participating employers in it, participating members. I could go to a new job with a new employer, and part of my compensation deal might be, well, I want you to put in 10% of my pay into this pension plan, and then that would follow you wherever you go. I think that structure makes a lot of sense. In other words, but not to sort of say, well, we don't need employers. Well, I think we do need employers. I think employers can stay part of the mix. And so it's really not necessarily employers, but not necessarily no employers either. Mm-hmm. And I think individual membership really takes care to a large extent of the problem of portability. In other words, you leave an employer, people change jobs, every 5 or 6 years, and then they have this little pieces of pension all over the place. And so they need to figure out a way to amalgamate them into an RSP. And of course, if they're transferring from a DB plan, then they'll get a tax hit because of the prescribed transfer limits. And so they end their career having worked for a bunch of different employers with pension plans, or maybe a group RSP, or maybe a deferred profit sharing plan. And they have to they've lost an opportunity to participate in a big pooled vehicle that operates in their interest.
Yeah, so on that note, one of the great problems of our industry is portability. In fact, the commuted value was originally meant to solve the portability problem. What is the role of multi-employer plans here? Can a multi-employer plan lessen the problem? We know, for example, that nurses who are members of the WHO plan and working in the same industry, perhaps changing hospitals, but they can stay in the plan all the same throughout their career. And even if they change employment and they have another pension plan, they can buy back service in the WHO. So what's your view? Can the MAP evolve to lessen the issue of portability?
Absolutely. The MAP is a perfect vehicle for that, because first of all, the more employers are in it, the higher the probability that when you move to a different employer, that employer will be a participating employer of the MAP, and so you won't have to change accounts at all. Obviously, it would have to be very big before all of the employers would be in there. But the multi-employer pension plan, particularly if it was possible to have individual membership, which of course it is possible, once you've in a multi-employer pension plan and you leave an employer, you no longer have any connection to that employer, but you leave your money in the multi-employer plan. Well, you are an individual member of the plan, and so recently the regulator, the Financial Services Regulatory Authority, had a committee, a technical advisory committee on missing members, and one of the outputs of that committee was a document which proposed that assets for missing pension plan members could potentially be amalgamated in larger structures. That was a public consultation document. And so that's obviously an opportunity to take care of people who leave employers and aggregate the assets into a single vehicle that is more likely to operate in their interest.
James, your plan can provide both defined benefit and defined contribution benefits. But for the moment, DC benefits don't include any form of lifetime income. What is your view of the recently permitted variable pay life annuities? You mentioned them a few minutes ago. Do you foresee changes in the way DC MAPs distribute income to retired members?
Well, a multi-employer pension plan is, compared to a single employer plan, is kind of an ideal vehicle if it has scale to provide retirement income effectively to people. Before the VPLA, it was only certain grandfathered defined contribution plans which were entitled to pay annuity income to members. And once the VPLA becomes available and it's fully implemented through federal and provincial statutory and regulatory changes, it offers a new option. Now, you can already pay retirement income from a DC pension plan in Ontario in the form of variable benefits, which are similar to benefits payable from a registered retirement income fund, but those are not benefits guaranteed for life. The variable payment life annuity is like any other pension, except that you have continued participation in the capital markets throughout retirement, so you can potentially get higher pension payments over the period of your lifetime because you still have equities in your portfolio, et cetera. But at the same time, the payment will fluctuate and you'll be part of a risk pool so that you will get a guaranteed pension payment until you retire, even though you don't know what the amount will be. My view, based on many years of providing educational programs to pension plan members and professionals, is that people will not voluntarily choose, for the most part, to purchase annuities. But that doesn't mean that the VPLA can't be helpful, because pension plan members tend to accept defaults, default contribution rates. If you give them the opportunity to participate in the pension plan, they'll be unlikely to opt in. But if you put them in and say you can opt out, they will be unlikely to opt out. Most pension plan members use the default investment, or many do in DC plans. And so if you default them into a choice of a variable payment life annuity, and similarly to the current rules, when they leave a DB plan, they can take a commuted value if they're more than 10 years away from retirement date, you could actually make the default a life annuity. And that would probably result in a significant uptake of that vehicle. And sorry, I also wanted to mention advanced life deferred annuities, because those are a new vehicle with the variable payment life annuity that the federal government has introduced that would provide some longevity insurance from, for example, age 85. And that combined with variable benefits could give you something similar to a variable payment life annuity.
James, you mentioned just now that people would not voluntarily buy annuities. And how would you explain the fact that one of the plans, Canadian plans, which were grandfathered to permit those annuities, people who retire from that plan, about half of them actually voluntarily choose annuities? That's a Saskatchewan pension plan.
That's difficult for me to comment on because I don't know the circumstances of that particular plan. But a lot of it, I think, comes down to education. If the administrator of a pension plan has essentially communicated to the members the advantages of annuities, and for example, if in that plan it's a variable payment life annuity, and they've talked to the retirees and the retirees are happy, pension plan members talk to each other. And so perhaps that's why. What I can tell you, and I'll admit that it's anecdotal evidence, is that in all of the discussions that I've had with pension plan members, and there have been many, they don't tend to want to buy annuities because they think, oh, well, if I purchase an annuity, then perhaps I'll only live a couple of years after it starts, and then the insurance company will take all the money. And they don't put a high value on the insurance they get from an annuity when you think about it. And then they have bequest motives, et cetera. So I think that, perhaps there is an example there of pension plan members, taking annuities, but you said it's 50%. Well, it should be 100%. unless they have some special knowledge about their life expectancy. And that brings into play another issue, is adverse selection or anti-selection risk. People are more likely to buy an annuity if they know that they're likely to live long, and less likely to buy one if they're not going to live long, or they think they won't. Insurance companies know that. They have to price annuities accordingly, which is one of the reasons why group annuity purchases are so much less costly than individual annuity purchases, because you don't have to deal with that anti-selection risk. So opting into an annuity uh, for that reason alone is rather problematic.
Mhm. Well, my last question for today is about regulation, which we know that pension regulation is notorious for its complexity. What would be the most important way, in your view, to reduce the regulatory burden on employers participating in a multi-employer pension plan?
Well, the first point I would note is that compared to participating or establishing and operating um, a single employer pension plan, the regulatory burden on employers and multi-employer pension plans is really light. And so the risks are quite light. That doesn't mean that there are no regulatory obligations, but it's certainly a whole lot less work and risk to participate in a multi-employer pension plan for an employer than it is to operate their own plan. But that being said, some of the ways that regulators could help employers participating in MEPs would be to authorize or allow employers to have electronic only communications, sign up, enrollment, et cetera, providing safe harbor liability protection to employers who comply with enrollment reporting and remitting requirements to sort of make sure that they understand that they have no liability for the administrative side at all. A favorite of mine would be to simplify the pension adjustment reporting requirements by having a reform of the tax rules so that you sort of change the factor of 9 and the accrual regime that we have now to a lifetime accumulation allowance structure, so that compliance would actually be dealt with by the plan custodians, not by the participating employers, and all of that pension adjustment reporting regime would go away. So I think there are opportunities to improve the employer experience in multi-employer pension plans. But that being said, it's a lot better than running your own plan.
Thank you very much, James, for your answers. They are definitely very, very deep, and I will endeavor to publish a transcript of this video. Hopefully, you will find other people interested. And thank you for your participation today.
Well, thank you for the opportunity. It was a very enjoyable discussion.